Okay, so good morning, everyone. Welcome to the Snapshot. We are Thursday, October the 9th, 2025. Okay, recording this in the morning, as always. Let's have a look and see what's going on overnight. Well, the first thing to notice is that we don't have any data. The US government, of course, is still shut down. So normally on a Thursday, we have initial jobless claims, which would give us a better read on the labor market, but we don't have any such data. So in the absence of data, there's a very, very low volatility in the bond market, for example, in FX. There's very, very low volatility. The market is really waiting for a directional change. So what we do have, we had the FOMC minutes yesterday that was released from the meeting from a couple of weeks ago. And essentially that gives us the picture, no real changes there. The picture is a picture of, one or two doves, mainly Stephen Miran, Trump's appointee, really sort of pushing the fact that the labor market's under pressure, the neutral rate is much lower, and that they're currently too restrictive, and therefore they should be cutting, 50, 75 basis points this year, and cutting more aggressively next year. There are also those who are still worried about tariff-induced sort of inflation cost and feel that maybe one cut was enough and we need to wait for more data. Then you have the central core who essentially supported the 25 basis point cut and are data dependent. But in the absence of data, of course, that becomes a bit problematic. So at this point, we have this equilibrium of a sort of a central core who are keeping an eye on both inflation potentially rising a little bit and being a little bit above target, and also looking at the labor market, which potentially is weakening. And then you have the two extremes. So at this point, I think where the market is essentially pricing in about a 44 basis points of cuts by the end of the year. Sorry, let me just bring up something. I don't think I have my the Bloomberg up. Sorry, that's gold. We'll look at gold in a second. Yeah, so apologies for this. Okay, so yeah, as I say, the market is pricing, about 44 basis points of cuts, but still for October, we still have a full cut priced in, 95% chance of that priced in. And what's interesting, we don't have any initial jobless claims. In theory, we have a CPI, so the inflation data coming up next week, but we may not have that. So you have the situation that the next Fed meeting on the 29th, so that's, what's that, 20 days away. Presumably, the government in the US will be reopened by then, but we could have a very volatile situation that we have no data maybe for another 4, 5, 6, 7, 8 working days. And then suddenly we have a flood of essentially unknown data. We could have a combination of a very weak employment situation and slowing inflation, or it could be something in the middle, or it could be the complete opposite, that we actually have evidence of a relatively robust a labor market with increasing inflation. So there's definitely risks to two sides, and that makes it very problematic to be trading, just because there's the risk of a binary outcome is quite high, and everyone is flying a little bit blind at the moment, including the Fed. Talking of the Fed, last night we had Williams, who is a voter and considered quite neutral, so he's the head of the New York Fed. It didn't say too much. He just said that he's looking at both mandates. But one comment which caught my attention, he did say, quote, there's a gradual cooling in the labor market. So he believes that inflation is going to tick up about 1/4 percentage point potentially because of tariffs, but he doesn't believe that's going to be a sort of systemic thing and sort of long lasting. And he, as we see from this quote here, gradual cooling in the labor market. So not a massive cooling, but a gradual cooling. So he seems to be in favor of, they did the one rate cut and possibly another one, but again, data dependent. So that's probably fairly typical and representative of what the Fed is thinking, or the majority of the Fed is thinking. As I said, no initial jobless claims today, so no particular data. If we look and see what's on the schedule, we're not getting any of this. Maybe University of Michigan preliminary numbers for October coming in tomorrow, but that's politically driven at this point and not particularly relevant. Okay, in terms of other stuff, probably the big news, and hopefully good news for the world, is that potentially a ceasefire and exchange of hostages in Palestine, in the Gaza Strip, between Israel and Hamas. So let's hope that works out. But in terms of the markets, what is interesting is that, just looking at oil here, if we look at oil, you can see here that oil had a little bit of a pop based on the fact that the OPEC meeting last weekend, if you remember, they only increased by about 137,000 barrels, which was less than the market had expected. And so we did bounce off this sort of pretty strong resistance here, or support, I should say, this sort of support here at around about 61. But what's interesting is that if we actually start just looking at the, let's call them the classical technicals, and we'll bring in maybe some EMAs and whatnot. You can see here that the resistance here was overhead at all the EMAs, and we can also see if we look at this fib level from here to here, we can see that again that coincides with about the 38%. We see that it's tried that a couple of times. So at this point, it looks as though the oil market is finding it difficult to push higher. Maybe it doesn't want to collapse at the moment, but it is trading with relatively distributive price action in a range. So for me, it seems that the bar for it to go higher is quite high. We would have to see maybe more sanctions, sort of supply disruptions, maybe OPEC Plus tightening their production a little bit, or evidence of a strong economy and demand in China and Europe globally, essentially. And talking about Chinese demand, I was reading quite a lot of research yesterday that it looks as though a lot of the Chinese demand, it's not really for industrial usages, but really is for sort of stockpiling. There's been a lot of stockpiling going on in China, and that's been soaking up some of the excess capacity, but that seems to be reducing at the moment slowly. So maybe China will not be the last sort of sponge to soak up extra production. But getting back to the point about sort of the Gaza Strip, it was interesting here that oil did go off a little bit just on that sort of news, but not a huge amount. So just sort of trading around here at the moment. What's also interesting in terms of that is gold. There's been a lot of talk about gold. So let's just look at a couple of things here. Gold, I'm just going to put it on the futures here. So we all know that it's getting a little almost parabolic. There's a similar situation here for silver. If we look at the silver futures, you can see not as parabolic, but a very, very strong uptrends above all of the moving averages, et cetera, et cetera. So what is going on with gold? Some people are calling for a reversal. And at this point, it does seem to me that gold, again, we maybe less geopolitical risk because of the hopefully the deal in Gaza. Maybe at some point a deal between the Ukraine and Russia, although that does seem a long way off. But what we are seeing in the gold market, it does seem that there is less central bank buying. We know that there's been a lot of central bank buying constantly over the last few years. It does seem that they're just at the moment reducing that a little bit. Maybe they're price sensitive, and also we're seeing less Chinese retail buying in gold. And so if you actually look at the numbers, really what's pushing gold up this last recent push has been an increase in ETF purchases, so Western ETF purchases, so Europe, US, et cetera, which actually weren't really participating that much in this earlier ramp up of gold. So the thing is for gold, what's driving it at the moment? What is driving it? I would say it's two things. It's the debasement narrative, this narrative that fiat currencies, paper currencies, only backed by governments, good word. There's more skepticism about that. There's more skepticism that governments globally are showing fiscal responsibility, and therefore gold, especially people calling it the boomer Bitcoin, for a certain generation is a bit of a safe haven. It's a store of value. You could argue that Bitcoin is trying to do the same thing, and gold certainly has had this huge run up. So the question is can this continue? Okay, let's look at a couple of charts. So I just pulled up, there's a lot of charts floating around, but I just pulled out four, which are kind of interesting. It is ambiguous and interesting. So for example, this chart here is looking at the percentage above the 200-day moving average. And you can see that we're now getting to a point where about 25, 26% above the 200-day moving average. Now, that means that it's very, very overextended. And last time we had that, talking in June, we're about 28% up. You can see that we did not really collapse, but we had just a bit of a sideways consolidation. Is it possible that we just get a sideways consolidation rather than rip higher or a collapse? That is definitely possible, but definitely very overextended by the RSIs, all of this kind of stuff. Now, another one to look at, for example, here's the RSI. Here's the gold price in in sort of orange here. And you can see that where we're at the moment with the RSI, around about 87. So obviously very, very overextended from a classical technical point of view. And the most overextended we've been would have to go back, probably like to 2020 or so to get up at those levels. But we all know that markets can continue going higher, even if they are, in theory, overextended. But one could also argue, like the previous chart, that that's an argument for, taking a pause. Now, another one is also to look at gold volatility. So here we have the gold price, these pushes up. But it's interesting that in the last push up, beginning of 2025, we did get a spike in volatility. A lot of people buying calls. So a huge premium of people wanting to participate through the buying of calls. Now we've got a little bit of a push up in the volatility bit of gold, the GVIX, as you can see here, but not nearly as much as we had last time. So is that indicating maybe less enthusiasm for this particular rally? That's an interesting one. And then finally, another chart I just want to look at here is speculators. So this is net non-commercial. So this is a futures positioning. And what's interesting here is that as gold has ripped higher, for sure, there's been an increase in the speculative positioning, but not as aggressive as we saw before. So you see that there's still not as much participation by speculators in the futures market. So that could argue for two things. Either that you could say, well, hey, there is more room for the speculators to add to their positions and keep this rally going, or you could say that it's a little bit of it's evidence of a lack of enthusiasm for gold. So the point I'm trying to make here is that if you look at gold, there's plenty of evidence from a technical perspective that it's time for a pullback, or at least at the minimum some kind of consolidation. On the other hand, you still have Western ETFs piling into it. There's still potentially room for speculators, non-commercial speculators in the futures market to increase their positions, which could push it up a little bit higher. That's where we're at. On the other hand, you could argue that if we do get the peace holds in the Gaza Strip, maybe there's a little less geopolitical risk. If things calm down in Russia, Ukraine, a little geopolitical risk. But it does seem to me that at a certain point, this will probably pull back. It's just the way markets are, maybe to 3,900 at a minimum. Not necessarily a collapse, but it could be just some kind of sideways consolidation, which we saw back in June and July, something like this, at a minimum. Because the arguments, that narrative of a debasement, are still true. Our countries are still running very, very high deficits. There's a complete lack of willpower to reduce deficits. So the idea of holding something which is a store of value, and it's not really that gold is going up, it's simply that its denominator, which is the US dollar in this case, is weakening to a certain degree. Although this is now outstripping gold, which is a US dollar, which has actually stabilized quite a bit. Anyway, enough of gold. Interesting in a couple of other markets here, just to look at what's happening in Europe. We saw that if we look at the euro just stabilizing a little bit, but the US dollar still quite strong, is still on this run, but just kind of starting to stabilize here just above the 100-day moving average. And it could be in Europe. If we look at Europe, there seems to be in France a little bit of progress there. If we look at the OATs, the French bonds here, you can see that they're pushing higher, and that's because the chances of a collapse of the entire government and the need for new elections, they seem to be diminishing. There was a sort of a statement released by Le Cornu, the caretaker prime minister, last night, essentially saying that Macron, the president, would probably reappoint or would probably appoint a new prime minister maybe by Friday, so that's tomorrow. And there was some sort of way of getting the budget through. So all that to say that the political heat has come out a little bit, and you can see here the French bonds have pushed a little bit higher. You can also see the spread between the French and the German has come down, and that at the margin has also allowed the euro to stabilize. And if you look at something, the classic hedge, like let's say euro Swiss franc, you can also see here that the euro, that's kind of stabilizing there a little bit as well. Although this morning, just looking at it, euro does seem to be down a little bit against the Swiss franc, but not in free fall as it was. So just a bit of a stabilization there. In terms of other markets, the equities, not a lot to say on the equities. We had the Delta Airlines, so we're starting to get the the earnings. We had Delta this morning. I just had a quick look at the numbers. They look relatively solid. We had an EPS higher than expected. The forward guidance looked relatively solid. So no particular shocks there, although I have to say I did have a quick look at the numbers. So it's not a final comment. If you look at the S&P here, you see it's grinding higher, new highs. Similar thing with NASDAQ. So the equity market is still strong, not particularly worried by the shutdown at this point, not particularly worried about geopolitical risks. Earnings is, we haven't had any particular hit yet to earnings. Let's keep an eye on the Russell, which is not as strong, but still doing quite well. If we look at the equal weight, you can see that, it's come off a tiny bit, but at the end of the day, look at the moving averages, still trading at highs. If we look at the Mag 7s, still trading at highs. And if we look at global equity, or let's just say European equity, if we look at the Euro Stock 600, powering to new highs. So the point is that at least in the US and Europe, equities are doing well. And at this point, the technicals are still the friend is in fact your trend at this point. You've got to stay in these markets. If we look over at Japan, which had the big pop, came off just a consolidation for a couple of days, but again popping higher as we speak. So global equity, Japanese equity. Still doing very well. No reason to think about shorting those at this point. There's no technical evidence to do that. If we look actually at what was I going to look at? I wanted to look at the Japanese yen, just talking about Japan here. You can see that the US dollar here has taken a bit of a pause. It's an interesting spot, courtesy of my friend Nick Carrier, who had a great chart yesterday. If you're watching this, Nick, thank you for the excellent technicals. But you see here, there's a downward trend line here. There's also a big, from the fib retracement here, coming to this level here, the 61%, about 153.5. So we're getting to a conjunction of levels, the top of this rising wedge here. So definitely the sort of decision time here for the USD JPY. But at this point, there's no evidence to be shorting it. But we should, in theory, be running against some sort of at least some time to sort of question this. Soon coming up to all of this is a confluence of sort of technical levels. One thing I would say, there's been a lot of talk that with there's just the low volatility in currencies is very good for the carry trade. And if you look at something like the Mexican peso versus Japanese yen. I mean, people talk about Bitcoin or altcoins. I mean, look at the peso versus the Japanese yen. So what you're seeing here is low volatility, which favors the carry trade. And you're also seeing a Japanese yen, which is weakening, if anything, as the funding currency. So, and you're getting appreciation from the Mexican peso. So people on this trade, institutions on this trade, must be pretty happy because since, let's say, April, May, you're up almost 20%, about 19%. So the point being, though, in terms of the Japanese yen, that as long as its volatility remains low and as long as there doesn't seem to be any particular pressure on the BOJ to be hiking rates, the carry trade globally will probably stay in place until it doesn't. But while it does stay in place, it could be that the Japanese yen could become the preferred funding currency for that, especially as the US dollar gets a little bit stronger. And that's another reason for the Japanese yen just to stay on the defensive. That's an interesting one there. Okay, guys, I'm going to leave it at that. Interesting to have a look at gold today and silver because a lot of people are, calling for that to reverse, which of course it does seem to be very, very extended from from a lot of technical indicators. Let's keep an eye on that. As I say, no particular data today. Just a bit of focused on the situation in Palestine and Gaza and Israel. Hopefully that will hold and that would be good for world peace. Okay, thanks very much. Have a great day. We'll continue this tomorrow.